Well, lots of earnings, so let's address another set. We've got on board with us Deepak Asher, Director and Group Head at INOX Leisure, joining us on the show right now. Deepak, hi, morning. Your profits have dipped in the fourth quarter while the other parameters have been healthy. What would you say attributed and went by in the quarter?
If you look at a broader or a larger view, 2019 I think has been a sterling year for INOX. Our key performance indicators on several parameters have shown not just spectacular but unprecedented performance. We have demonstrated what might be the largest footfalls achieved by us ever, the highest ticket price achieved by us ever, the highest spend per head on food achieved by us ever, the highest advertising revenues achieved by us ever, the highest revenues, the highest EBITDA and the highest profitability achieved by us ever for the full year. EBITDA has grown by more than 50% from 210 crores to 309 crores. Net profit has grown by more than 100% from 61 crores to 129 crores. And this has been because of the investments that we made in new screens and on the existing screens, in technology, in service, in luxury, in convenience to customers, has all paid rich dividends. So we believe we've shown significant improvement in all operating parameters that has led to a significantly healthier top line as well as bottom line. On the other hand, the screen additions that we've achieved this year are not just the highest that we've ever achieved, but these are the highest screen additions achieved by any multiplex chain in the country ever. 85 screens added during the year translates to almost one screen opening every 4 days. This represents about 40% of the screen additions achieved by the entire industry, and based on the pipeline that we have going forward and the extremely strong balance sheet that we have, we believe we'll be able to maintain this momentum of growth going forward as well.
Okay, your operational performance has been healthy. Do you think that this kind of a margin growth is sustainable for you?
Yes, we do believe, as I said, that the investments that we made in the new screen openings as well as improving the operating parameters on the existing screens will lead to revenue numbers and profitability numbers which are not just strong but also sustainable and scalable. So we believe we should be able to maintain this momentum of growth going forward as well.
Currently, F&B revenue contributes about 26% to total revenue. How have your F&B revenues been in Q4 and what's the outlook?
So if you look at the full year, and I have my numbers for the full year in front of me, the spend per head on food and beverages improved from 66 rupees per patron in 2018 till about 74 rupees per patron in 2019. That's a growth of 11%. We've done several things in order to improve our food and beverage revenues. We've introduced very vibrant menus. We've had live kitchens in many of our properties. We've introduced items on the menus which are theme oriented. So if it's a new film that is getting released, or if there's a local festival or regional content which is coming up, the menus are based on themes which are based around that content. We've increased the point of sale for our food items. We've provided a lot of convenience for our customers to be able to order food from the comfort of his home or the comfort of his seat when he's within our plex, apart from the fact that we have queue busters across our properties, and all this has led to a significant improvement in food and beverage revenues.
You've also seen the highest yearly ATP at about 197. What's the outlook on ticket prices and also spends per head?
Yes, but before that, I'd just like to do a minor kind of course correction. The improvement in ticket prices could potentially have been better. It currently is from 193 rupees going up to 197 rupees, which shows a 2% kind of growth. But this is after considering the fact that with the reduction in GST from 28% to 18%, and this benefit of reduced GST was passed on to the consumer, our average ticket price actually went down, and therefore this 2% increase reflects the reduction in ticket prices after the GST reduction. So had it not been for that, I think we'll be able to maintain 5 to 7% growth in average ticket prices as we have been maintaining historically.
Mr. Asher, now you have seen INOX, which has been very aggressive when it comes to screen additions. You've added 71 screens this year. What is the outlook? Are you on track with your screen addition plan? Are you even looking to increase your penetration into the tier 2 and 3 cities?
Yes, I think the industry is horribly underscreened. We have less than 3 screens per million population in India. For a country for whom the primary form of entertainment is cinema watching, I think there's room for a lot more screens. So we are looking at not just tier 2, tier 3, but we believe even in tier 1 towns and cities there are going to be significant scope for growth. We ourselves have signed up properties equivalent to about 850 screens. Now this obviously is not all happening in the next 1 or 2 years. This is going to take time to implement, but we have a committed pipeline of about 850 screens, of which, in addition to the 85 screens that we opened last year, which is FY19, we expect in this year, FY20, to be able to open around 80 screens this year as well.
Are you worried about competition from OTT players because they're upping their offering? Is that a concern, and what is the strategy to take them on? Do you in any way see your market share being impacted?
We don't believe OTT really competes with cinema because, cinema out-of-home entertainment is something that has always been in vogue. In India, it is all the more, the cinema-going culture is all the more ingrained in the habits of the youth as well as family audiences. So we believe regardless of what happens on OTT, people will still want to go out to see a movie in a cinema theater and enjoy the entire experience of an out-of-home entertainment.
Right. Is there a strategy in place to expand businesses by acquiring smaller multiplex chains? And what are the other projects and acquisitions that you may have in the pipeline?
Well, we've never been averse to acquisition opportunities. We've always been looking out for them. In fact, we were the first chain to have started the acquisition spree in this business when we acquired a brand called 89 Cinemas, and then we acquired Fame, and then we acquired Satyam. So we've been looking at sense-making acquisitions. Our only concern there is that it should come at a value which is sense-making. In other words, it should improve our return on capital employed. And if you do find such an opportunity, we would be happy to look at it.
So with competition also upping their game on luxury offerings, do you see that hurting market share for Insignia? Will you look at any price revisions?
Well, first of all, I don't believe this is going to hurt each other. As I said, the market is large enough. If you look at the number of screens I mentioned, this is less than 3 per million population in India. In China, the corresponding number is about 30 screens per million population. So we believe there's headroom for growth, and I believe all the players that currently operate in the market can grow fairly significantly without having to tread on each other's toes.
And with your plans to add 50 screens each year, as you're eyeing a revenue of close to 2,000 crores over the next 3 years, what kind of a revenue CAGR do you target?
Well, we hesitate to provide you with forward-looking financial numbers, but suffice it to say that the momentum of growth that we have witnessed over the past few years and the investments that we are making in maintaining that momentum of growth will ensure that our financial performance on revenues, on EBITDA as well as PAT will not only be strong but even scalable and sustainable.
All right, we'll let you go on that note. Thanks much for joining in and giving us a flavor of how the quarter has shaped up. That's INOX, and it's been a pretty steady quarter on pretty much all parameters barring the profits. So margins have come in very healthy. The overall box office collections as well have been strong, and footfalls coming in healthy.